If you are poor, banks do not see you as a problem. They see you as a product. Not because you are lazy, not because you are irresponsible, but because the system is designed to extract money from people who have the least power to say no. Today, we are going to break this down slowly and clearly. No complex terms, no bank language, just the truth. This episode will show you how banks make money from fees, interest, loans, and debt traps, and why poverty is not an accident in the financial system. Let's begin. Banks like to present themselves as helpers. They say things like, "We help you save. We help you grow. We help you manage your money." But banks are not charities. They are businesses. And every business has one goal: profit. The question is not whether banks make money. The real question is, who pays for that profit? The answer is simple. Mostly, ordinary people, especially people living paycheck to paycheck. Let's start with fees. Fees are one of the quietest ways banks take money from you. You open an account. They tell you it is free. But nothing about it is truly free. There is a maintenance fee, a card fee, an SMS alert fee, a withdrawal fee, a transfer fee, a penalty fee. Each one sounds small, but together, they bleed you slowly. If you are rich, these fees barely touch you. If you are poor, they hurt. Why? Because when you live close to zero, every small charge matters. A single unexpected fee can mean food, transport, or data lost. Banks know this. That is why many fees are designed to punish low balances. If you don't keep enough money in your account, you pay more. Think about that. The less money you have, the more they charge you. That is not an accident. That is a business model. Now let's talk about overdrafts. An overdraft is when the bank allows you to spend money you do not have. They sell it as help. Don't worry, we've got you covered. But overdrafts are one of the most expensive forms of borrowing. The interest is high, the penalties are aggressive, and the repayment is automatic. The moment money enters your account, the bank takes theirs first. Not your rent, not your food, not your transport. The bank. If you fall behind, the fees multiply. Interest on interest, penalty on penalty. A small overdraft can trap you for months. And banks know that people under financial stress are more likely to use overdrafts. Stress makes people desperate. Desperation makes people accept bad terms. Next, let's talk about interest. Interest is how banks make most of their money. When you borrow money, you don't just pay back what you took. You pay extra. That extra is interest. In theory, interest is the cost of borrowing. In reality, interest is priced based on power. If you are rich, banks trust you. You get low interest rates. If you are poor, banks fear you. You get high interest rates. This means the people who need money the most pay the most for it. Think about how unfair that is. Someone already struggling is charged more for help than someone who already has plenty. This is not about risk alone. It is about control. Now let's talk about loans. Loans are often presented as solutions. Loan for school, loan for business, loan for emergencies, loan to survive. But many loans are designed not to free you, but to bind you. Short repayment periods, high interest rates, harsh penalties for delays. Miss one payment, and the debt grows. Miss two, and it explodes. Before you realize it, you are no longer paying the loan. You are paying the interest on the loan. Your original problem remains. But now you also owe the bank. This is how debt becomes a cycle instead of a bridge. Now let's talk about credit cards. Credit cards feel powerful. You swipe. You buy, you feel in control. But credit cards are one of the most profitable tools banks have. Why? Because they are designed to delay pain. You get the item now. You feel the consequences later. Minimum payments make it worse. They make the debt feel small. You pay a little. The balance remains. Interest keeps growing. Many people pay credit card bills for years and still owe more than they borrowed. The bank is patient, because time works in their favor. Now let's talk about the debt trap. A debt trap happens when debt stops being temporary and becomes permanent. You borrow to solve a problem. The repayment creates another problem, so you borrow again. Loan to pay rent, overdraft to pay loan, credit card to cover food, another loan to survive the month. This is not because people are foolish. It is because the system offers debt faster than it offers income. Banks do not create wealth for you. They rent money to you, and the longer you rent, the more you pay. Here is the most important part. Banks do not want everyone rich. They want a balance. Enough people stable enough to repay. Enough people struggling enough to depend on loans. Poverty is profitable when it is controlled. Too poor, and you default. Too rich, and you don't need them. The sweet spot is dependence. So what is the lesson here? Banks are tools, powerful tools, but tools work in favor of the person who understands them. If you do not understand how banks make money, you will always feel like money disappears. Not because you are bad with money, but because the rules were hidden from you. In the next episode, we will go even deeper. We will talk about the biggest financial lie taught in schools. A lie so effective that generations believed it without question. They removed this lesson on purpose. And once you see it, you will never look at education or money the same way again. That is episode 3. Do not miss it.